thank you everyone for attending here Monday morning to talk tax policy. So I think we just started off with maybe if each of our presenters could introduce themselves, and we'll start with Mel on the top left.
Yes, I'm Mel Schwartz. I'm the Director of Tax Legislative Affairs here at Eide Bailly, located in Washington, D.C., and which has been my my professional home for the last 40 some odd years now. And I'm quite frankly a little tired of the sausage factory, but hope we can bring a little bit of sense to what's going on up there right now.
Excellent. Thanks, Mel. So my name is Adam Sweet. I'm a principal in our National Tax Office. My really primary focus is pass-through entities, partnerships, and S-corps. You may have heard my voice a time or two covering the Paycheck Protection Program over the last year, but really this is more my element here, tracking tax policy and how that may affect kind of small, medium-sized businesses, Eide Bailly's primary clientele. So again, thanks everyone for attending.
My name is Jay Heflin. I'm with Mel here in Washington, tracking the sausage factory. And for those who don't know, the reason why it's called the sausage factory is because legislation gets ugly when it's made, just like sausage, and it's getting ugly now, which I'll talk about that later on in the presentation.
And I'm Shannon Lamont. I'm the partner in charge of international tax services for the firm for Eide Bailly, and I am located in Colorado.
Hello, I'm Ava Archibald. I'm a principal in charge of our Wealth Transition Services Group, and I'm located in our corporate office in the Fargo location. And I have to say, in my 30 years of practice, this is the most interesting year that I've had with all the proposals that are going around.
Excellent. So this is kind of our agenda for the day. We only have an hour. We have a lot of material to get through. So I think we're going to be pretty high level on things. And to the extent people have questions, if we're able to get to them, we're happy to bring them up. Otherwise, we'll try to follow up afterwards. So first of all, we'll introduce and kind of give a brief overview of what is the genesis for this webinar. It's the Green Book that was released by the administration a few weeks back. And then kind of dive into some of the details. Really probably what grabbed most people's attention were the proposed tax increases, both corporate, individual, and for investment capital gains. Also some very significant estate and gift proposed provisions, some very material changes to the international tax regime. Really that was changed back in 2017 and now proposing to do more significant changes. And then we'll have Jay at the end to kind of give us a wrap up and a way forward for, will this get passed? What will be the form? How does it get passed? Will only parts of it get passed? So again, sorry, we're going to cover a lot of material in short order. It may be not as much detail as everyone would like, but maybe as the summer goes on, we'll have further webinars covering some of these topics in more details if it looks like that some of them will come to pass. So for starters, everyone uses the term the Green Book, and I saw it, in the Wall Street Journal. It's in all the tax press. The Green Book that was released by the Biden administration on May 28, 2021. And maybe I turn it here to Mel as our senior statesman of the group. That what is the Green Book, and why should a taxpayer care, and why do tax advisors? Why is it important?
The actual title of the Green Book is the General Explanation of the Administration's Fiscal Year 2022 Revenue Proposals. And that is exactly what the Green Book is. It is really our first shot at some explanation of the details, the effective dates, the general idea of how these proposals may apply in practice. Previously, we have seen some fairly general policy-based statements, both through the American Families Plan and also the American Jobs Plan. This is the first shot we have at really seeing some of those details fleshed out. Now, not every detail is fleshed out. One of the big questions has, I think, been when the president has said he's not going to increase taxes on those making more than $400,000. What does that mean? Is that a adjusted gross income? Is that some modified adjusted gross income? Is that taxable income? And it turns out that the answer is it's not consistent. and that in fact we will be, or the current proposal is to use all three of those for various different proposals. I think another question there was, does this apply on a individual by individual basis, or does it apply to a single taxpayer entity like a married couple filing a joint return? So a single person can go to $399, but if two married people go to $399 a piece, they are well above the 400. And unfortunately, we don't really have the answer to that one, except possibly for the individual tax rates, which do have their own specific table. As Jay has often reminded me, it's important to remember that the president proposes, but it's Congress that disposes when we're talking about legislation. And the president's budget is not legislation. The Green Book is not a legislative document. They really have to be viewed as aspirational documents that show where the president's legislative priorities are. Congress is not bound to include any of them. It is not bound, and it retains the power to modify, reject, or add to the items that are in the Green Book. It's a good guide to where we are at the beginning of the process, but it's only that. We're at the start of the process. We're going to have to monitor the changes that are made as this process goes forward.
So fair to say that if the tax changes we're going to talk about here for the next 50 minutes, it's not like these are going to become law tomorrow necessarily.
No. And I think that probably I wouldn't hold my breath as to whether they're going to become law by, let's say, Labor Day. On the other hand, some of the effective dates that are proposed, at least one of which is retroactive, could well stick. Might not, but could well stick.
So with that, let's dive into, so really, this is my part of it, and I tried to keep it simple, so I called it rate increases. And this is probably what's grabbed the most attention from people, that is part of, their infrastructure plans and the Biden's administration's other plans, legislative priorities to pay for it. One of the things they've said is that they're going to raise, or they would like to raise, tax rates. And really, it's potentially tax rates across the board. So the first one, maybe the headliner, is the corporate tax rate, which previous to 2017 could be as high as 35%. After the Tax Cuts and Jobs Act 2017 was brought down to a flat 21%, and the Biden administration has proposed raising that to 28%. Now, Jay's going to cover this in more detail, but really the late breaking news of last week is that in fact, the Biden administration may be backing away from this rate increase to 28%, and instead asking for some kind of an alternative tax called a book minimum tax. And Jay will, if you're wondering what that is, I think Jay will spend some more time later in the presentation there, but it just shows you too that the Green Book was released 2 weeks ago, and within 10 or 12 days already, there's modifications there to one of those proposals. Along with the corporate tax, so corporate tax is what C corporations pay. C corporations, think your big, Amazons, your Nikes, your Apples, and so forth, where they pay tax at the entity level, and then they pay tax again, or taxes paid again when a dividend's paid out. But also the top individual rates have been proposed to increase from 37 to 39.6%, which I think, Mel, that was the rate that was the highest marginal rate that was in effect before the Tax Cuts and Jobs Act of 2017.
That's correct, Adam.
For a big deal for really the real estate industry is a repeal of Section 1031 like-kind exchanges for gains in excess of 500 grand, which would be hiked to $1 million for married filing joint. Right now, if you sell real property, you can roll over, there's really no limit. You can roll over the gains, the capital gains from the sale of the real property, as long as you buy property of a like kind, and you can defer those gains. You take a rollover basis. Eventually it's not permanent. Eventually the gain is triggered, but there's no top cap to it. So as part of this Biden proposal, they've said, well, there's going to be a cap now. So if it's gains in excess of $1 million, if you're married filing joint, you would pay tax in those amounts. You wouldn't be able to roll it over. So this has made waves in the real estate industry. We'll see. Real estate industry is a pretty powerful lobby up on Capitol Hill. So we'll see does this survive or not survive, or in what form it survives. The fourth bullet is a big deal to a lot of our client base and to a lot of taxpayers. Right now, there's a hole in the statute where if you're an owner of an S corp, or potentially if you're an owner of a partnership with the right set of facts, you can take your share of what I'll call non-self-employed flow-through earnings, and you can escape both the net investment income tax and the Medicare surcharge. Now, I should put quotes around it because it's a very general statement and it doesn't apply to everyone, but there's kind of a hole there. I think originally when the net investment income tax was passed, along with this Medicare surcharge, it was intended that one or the other would apply to kind of these excess non-self-employment earnings. And there was a glitch in the statute, or perhaps it was intended. So now they've plugged that, and basically what they are proposing is that if your income is in excess of 400 grand on your non-self-employed earnings from an S corp or from a partnership, you're going to either pay the NIT, the 3.8% NIT, or you're going to pay the 3.8% Medicare surcharge, one or the other. So in short, I have that sub-bullet, but I think it's safe to say that if on your non-corporate trade or business income, you're going to be paying tax on one of those. If you make more than 400 grand a year, you may not be paying tax on either of those right now. Also, very interestingly, very relevant to my practice, is there's no mention of the Section 199A QBI deduction, which is when the corporate rate was dropped to 21% in 17, they gave us this 199A QBI deduction, which lowers the rate of tax paid by owners of pass-through businesses. I was on a webinar a few weeks ago where there's a Treasury spokesman who had just said that they thought it was too complicated to try to touch 199A, and they may instead just kind of let it die on the vine, because right now 199A is scheduled to expire anyways in the tax year 2026. So they, being the administration, may just let it be for now and just say, well, 5 years from now, it's gone anyways, unless of course it's extended. So that was a big deal for us, because even on the campaign trail, I think Biden's, one of the things he was talking about was phasing out the 199A deduction for people that make in excess of 400 grand. No mention of that here in the Green Book. And then perhaps the biggest headliner, and really to Mel's point there about a retroactive tax, that's the reason why it's grabbed so much attention, but they've been talking about for the last year about raising the rate on capital gain, long-term capital gains and qualified dividends. Currently, those items are taxed at rates between 15 and 23.8%, and that really depends on what your adjusted gross income is, and then your level of activity potentially, or your level of activity in the business. And what they've said is, well, first of all, they're going to do away with those preferential rates if you make more than $1 million a year, and instead long-term capital gains would be taxed at ordinary income rates. So it could go from 23.8% to 39%. But perhaps more attention grabbing was this statement in the Green Book that the rate increase would generally be effective as of the date of announcement. And I put May 28th as a question mark in there because that's the date of the Green Book. And I'll turn it to Mel in a second, and even there may be a question there, but maybe my first question, Mel, is this, given that we have no legislation yet, could you call this a retroactive tax?
Oh, yeah. I think that anytime you have transactions that occur prior to the enactment date of legislation, you say that that is to an extent retroactive tax, particularly one here where we're talking about it. Certainly the logical conclusion to recognized after the date of announcement, since that phrase appeared in the Green Book, was the date of announcement of the Green Book. Turns out that's not what the administration has in mind, but in fact, the date of announcement is the date for them is the date of announcement of the policy in the American Families Plan, which takes us back into an April date. I believe it's April 28. Correct me, someone, if I'm wrong on that. The policy seems to be that if they're going to increase the rate, they do not want to provide a window of opportunity for people to race out and recognize capital gains at the lower existing rate. And so consequently, they just shut down. The proposal is to shut down and not provide for that opportunity. Now, some other people have raised the question of, but wouldn't you raise more revenue? And keep in mind, this is a revenue raising proposal as well as a wealth distribution proposal. Wouldn't you raise more money, more taxes, if you encourage people to run out and recognize their capital gains? And I think we're going to see a debate over that as we go forward. And one thing to watch there is going to be, do they allow you to voluntarily recognize capital gains, which has been discussed in the past with regard to prospective capital gains increases. I think, and Jay's going to fill us in on some of the overall details. There's a tremendous amount of pushback already with regard to this April date. And I think that the expectation is that at a minimum, this is going to slide to, perhaps a date of tax writing committee action. But again, it would not surprise many of us that this made it all the way to probably the date of enactment, not necessarily, or the date of passage, not necessarily all the way to the end of the year. Although, again, if you want to maximize the revenue, it may well be that encouraging people to cash in, and this will certainly encourage people to cash in if you know that the rate is going to increase. That may be a debate that we will see play out in the future. Everyone has to make their own choices with regard to what their tolerance for risk is. And I think that's something that has to be seriously considered anytime you're talking about a significant capital gain that would potentially be subject to this, that might happen this month, might happen next month, might happen next year. I'd say anytime within the next 3 or 4 years, you begin to think about, well, is the possibility of getting on the lower rate something that I need to think about? Or am I better just operating my business and letting the chips fall where they may?
And maybe one real quick question. So when you say voluntarily recognize, what does that mean exactly?
Well, the old proposal was to say, if you have an embedded capital gain, you have an unrealized capital gain, you may elect to recognize some of it or all of it. And the feeling was, at least at the Treasury Department at that time, people are unlikely to overestimate and overpay the tax in order to create a capital loss going forward. So there is not a valuation issue. And also keep in mind, if we see something of a race to recognize gains, and you actually have to sell something to recognize the gain, then you're really messing with the economy. You're going to cause some dislocations there. And that may be one of the other reasons that the administration looked at this early effective date, is they did not want to have those dislocations as well. The solution to the dislocation is to say, okay, you don't have to sell the property, but you may recognize the capital. If you want to pay some tax, fine. We've got a big budget deficit. We'll take some tax and let things go on. But again, a lot of different directions this one could go, and I think this is just one that we have to stay on top of as it develops.
Yeah, good point. We had a question from the audience: would the $1 million threshold include the capital gain? The answer is yes. Because I think right now it's based on adjusted gross income, so that would be income from all sources.
Right. The assumption is that that the capital gain will stack last. Yeah. So in other words, if you've got $600,000 of other income and a $500,000 capital gain, you've got $100,000 of your capital gain subject to the higher tax, presuming that the proposal goes forward as it's currently structured.
Got it. All right. And with that, we'll turn it over to Ava.
So I'm going to speak just a little bit about what was in the Green Book for the estate and gift tax world, and what we thought would be in the Green Book. Possibly, everybody is probably discussing most amongst themselves the estate, gift, and GST rates. That was not discussed in this Green Book. The thing that affects the gift and estate tax world is the stepped up tax basis and the elimination of the stepped up tax basis. Because right now, under our current laws, if someone dies with their assets and they hold them till death, when they pass them to their heirs, they get a free stepped up tax basis. So their heirs start out with their tax basis for income tax purposes at today's value. If someone gifts today, the donee, the person receiving the gifts, is going to receive those gifts based on the donor's tax basis. So it just carries over to the donee or the recipient. Here under discussion under Biden's plan is they want to eliminate the stepped up tax basis, but provide a $1 million per person exclusion from recognition of that capital gain, both on gifts during life and at death. So the donor or the deceased owner of those appreciated assets would realize a capital gain for the donor. It would be the amount of the gain realized that would be in excess of the assets at the fair market value and the date you give to what that donor's basis is. And then at death, it would be that date of death value to whatever the decedent's basis was. The gain would be taxable on a federal gift or estate tax return or on a separate capital gains return. That's what's indicated in the Green Book. I'm not quite sure how that will play out for sure. If that's going to be a whole separate form when they talk about a separate capital gains return, because sometimes they refer back to the decedent's personal income tax return, where they mention that the use of the capital losses or carry forwards from transfers at death would be allowed to use against that capital gain income. And you would still get the $3,000 loss you could use against ordinary income on the decedent's final income tax return. So it'll be interesting to see if this does pass through Congress, how they're going to have this play out in the reporting format, because they're referring back to here the decedent's final income tax return, but yet referring to a separate capital gains return. The tax imposed on gains is deemed and realized at death would be deductible on an estate tax return for a decedent's estate. So there were some comments in some proposals earlier about this. So this Green Book has noted that there would be a deduction. So again, we're not talking about, at least in Biden's proposal, doing away with or changing the estate tax exemption. So we'll have a tax on the stepped up basis issue, and we'll still have our estate and gift tax. Nothing was noted, however, how you would handle that on a gift tax side if you've already used all your gift exemption. The exemption or exclusion that we're talking about is $1 million per person, $2 million per married couple. And then in addition to that, there's exclusions for tangible personal property, transfers to a spouse, transfers to charity. The spouse must be a US spouse. Capital gain in certain small business stock, and current exclusion of $250,000 per person for capital gain on personal residence exclusions. So we have that exclusion of $250,000 per person currently in the rules for income tax, that you can exclude that amount from gain. You'd be able to exclude that from this $1 million gain. So really it'd be $1 million plus the $250,000. The thing to think about though, especially for people in states where the residential real estate sometimes is a main asset of some clients, some taxpayers, that is going to be included in that $1 million gain other than that $250,000 exclusion. There's also exclusion for family-owned businesses and farms if the assets are given to an heir who continues to run the business or farm. It was a question when the American Families Plan came out is, how for a term, or how long would this gain be would not have to be recognized for that closely held business or family farm? Well, there's clarification now in the Green Book that it's as long as there's a family member carrying on that family business or in the farm. Then my other question when the American Families Plan came out is, what happens to these closely held businesses and farms when they don't have that family member carrying on for them? seems there might be some relief hinted in the Green Book because it does mention a 15-year fixed rate payment plan for taxed assets other than publicly traded financial assets and other than businesses which have made the deferral election. So if they did make the deferral election, it looks like there's a 15-year payment plan possible. So that could be a benefit. The gain on unrealized appreciation recognized when you have an owner of property held in a trust, partnership, or non-corporate entity was noted that that property, if it has not been subject to recognition event prior to 90 years, would need to recognize that unrealized appreciation. This was something interesting, I think, and what they're probably trying to avoid is having assets gifted to a trust, let's say, and it's a long-term trust, maybe a dynasty trust, and the asset is in there that just continues to appreciate, but it's really never sold, so there's no gain triggered. This proposal is saying you can only do that for 90 years, and your testing period is going to start back from January 1 of 1940. I don't know what the magic was to 1940 or why they picked that date, but it means the first possible recognition event for the taxpayer under this provision would be December 31st of 2030. So if this would pass come 2030, if we have any of these long-term trusts where assets were just rolling and gain was never recognized, and someday, would be if it was ever sold, here it would be recognized even if it wasn't sold. This exclusion we have, or exemption amount for the capital gain, that's going to be indexed for inflation after 2022, and it's portable to the decedent's surviving spouse. That's a surprising benefit I wasn't aware of when Biden first put his plan out, but this is a benefit that we can, if you don't use that $1 million exclusion on the first death, you'll be able to make that portable to the surviving spouse. The effective dates here for the property transferred by gift or estate is going to be December 31st, 2021. And then January 1st, 2022 for those properties that are owned by trust, partnerships, and other corporate entities. Don't know, there's a difference of a day in there, but maybe for tracking purposes of the trust, partnerships, and entities starting on the January 1 date makes it easier back to that 1940 date.
Maybe we had one question come in. It says, does the Green Book define heirs as strictly children, or do nieces and nephews count?
It did not specify. So I assume once this goes through Congress, they'll be tying this to other provisions. So some of the farm provisions we have now, they do include, nieces and nephews. Some provisions are strictly lineal descendants. So we'll have to see where this plays out to be. And
then finally, these proposals, and they're not law, but proposals are pretty monumental. I mean, I use the buzzword there, the elimination of stepped up basis, but what should taxpayers be thinking about right now in terms of planning? It's uncertain whether this will get passed, but what should people be thinking about?
I think people don't want to make rash decisions because this Green Book, like you said, we don't know if it's going to pass or not, but it's a great time to review your plan and look at your planning documents. How do things pass on death? And if you are, thinking about transitioning or gifting assets, maybe currently you're looking at gifting that family-owned business, maybe meeting with your advisors. What is your game plan that you want to do for personal reasons? What are your personal goals? And then let's be ready to have a game plan if this would go through. You hate to do something rash and make a decision now and this doesn't pass, because this is a really big step where before, when they talked about, or even in 2010, they did away with the stepped up tax basis. Then they had the stepped up tax basis rules, and then they did away with the estate and gift tax exemption. Here we're going to have both. So it's going to be a little different this time around.
And then we'll get it to Shannon here in 30 seconds, but one other question. So the question is, so am I understanding it right that the current 11 million joint is going to 2 million? And that I guess this would be if this becomes law exactly as proposed.
No, it's two separate things. So you'll have, right now as it stands, that Green Book did not address the estate tax exemption. So you still have your estate and gift exemption of 11.7 million to pass and not cost tax. But in addition to that, you're going to have this tax, income tax, on the recognized capital gain of the assets on death, difference between fair market value and the basis of the decedent. That tax that's generated under that stepped up basis rule, or elimination of stepped up basis, is going to give you a credit or a reduction of your estate tax. So right now, as it stands under that Green Book, you'd still have your estate tax exemption, and then you're going to have a whole nother set of rules to watch for on the basis issues.
Yeah, good. All right, and Amy, with that, we'll turn it over to Shannon.
Excellent. Thank you, Adam. So I'm going to unpack some of the international tax provisions that were in the Green Book. Very extensive items, and so I will only be able to touch on them at a high level. But first off is changes to the GILTI regime. You may recall a few years ago, we were gifted the GILTI regime as part of tax reform. It stands for Global Intangible Low Taxed Income, and the purpose of it really was to look for low taxed income in U.S. companies, foreign subsidiaries, and tax that on a regular basis, on an annual basis. As part of that regime, they gave us a safe harbor, which was 10% essentially of your fixed assets in the foreign corporation. That amount would not be taxed. All the rest would be tested income and potentially subject to tax in the U.S. If you were subject to tax, if it was subject to tax in the US, you could also take a foreign tax credit, however, limited to 80% of that credit. And so essentially what happened was, where there used to be only subpart F income would be taxable in the US on a current basis, now we have this GILTI income. So that was new. Well, now what they'd like to do is tweak that even more, even further, and eliminate that Q by safe harbor, so that fixed asset safe harbor that we are allowed to take, and also make it so that you would calculate that on a country by country basis versus being able to pool all of your income from foreign subsidiaries. So you could have, taken losses against gains, losses in one country against gains or income in another country. And also do the same thing with respect to the foreign tax credit calculation that you would need to do as well. In addition, they would reduce what we call the Section 250 deduction to 25%, and that currently is 50%, resulting in an effective tax rate on that income of 21%. So it used to be that corporations were able to take a deduction of that GILTI income of 50% of it. And so you were really only subject to tax at a 13 1/8 percentage. And also, or sorry, 10.5%. And then also they would, and this is a big kicker, especially for our pass-through entities in the US, they would repeal the high tax exception. So in the subpart F regime, there's a high tax exception that says, if you have an effective tax rate in that country of at least 90% of the US tax rate, currently that would have been 18.9%, then no additional GILTI pickup, or sorry, no subpart F income pickup. And they expanded that to cover GILTI as well, which was a nice way to avoid having to go through all of these calculations and iterations with respect to foreign companies that are, in higher tax jurisdictions. And I think that makes sense, given that they're not there for, tax avoidance or tax planning purposes necessarily. So this, in the Green Book, they have proposed to repeal the high tax exception. That would be very punitive, especially for our pass-through entities who don't get that Section 250 deduction. So all of that income of the foreign companies would be subject to tax immediately in the US. for those taxpayers. Then we have also, they included a repeal. There used to be an exemption for foreign oil and gas extraction income, and they would repeal that for purposes of GILTI as well, and expand the definition of it as well. So I mentioned the impact on pass-throughs. I did want to say that, you know, when we're looking at taxpayers and they have a number of different partners, for instance, or S-Corp shareholders, only the 10% shareholders would pick up the GILTI. And oftentimes what we're doing is making Section 962 elections to be able to take that Section 250 deduction. So there's some modeling that we have been doing, and it's going to be even more important if this does look like it's going to pass, to do that modeling and also look at maybe there's some other structuring options that we can look at, but we won't have likely a lot of time to do so. Next slide. Some other items I already mentioned, that the high tax exception that would be applicable to subpart F as well, and that would be repealed. Also, they're looking at disallowing deductions allocable to exempt foreign gross income. So remember that Section 250 deduction, if you have expenses allocated to foreign income that's not subject to tax, those would be disallowed. In addition to, we currently have dividends received deduction for some of the profits that aren't already taxed, although I'm not sure how applicable that will be anymore with the GILTI, the new GILTI regime. Those would not be allowable as well. They would also, and this is a big one, probably deserves its own slide, but they would repeal the FDII deduction. So the FDII deduction was where if you had income from your company in the US with respect to sales outside of the US, you are allowed a deduction for that. And this provision calls for the complete repeal of the FDII deduction. So that would be huge for those US companies that are exporting goods or services. And then also they would be limiting foreign tax credits from the sale of hybrid entities, and they're doing that by way of looking at the sourcing of the income. So that's another one as well. The next slide talks to the anti-inversion rules. So these came into play quite some time ago, where what was happening is US companies were finding a foreign parent, foreign company, oftentimes much smaller than them, and they were essentially having that foreign company come in and take control of the US company and ultimately end up with the same shareholders, so that it looked more like a foreign corporation, and then stripping all the CFC income or the foreign entities out from under the US company. So that these rules were put in place to make that action punitive from a US tax perspective. And the proposals in the Green Book would essentially make this even more strict of an ownership test. So it used to be, we had two thresholds. One was a 60% if the shareholders of the new foreign company are 60% the same of what the US company was, then there was a provision where you would have to recognize some gain and some income in the US going forward. And then if it was 80% of the same shareholders, you would essentially, well, that foreign corporation is going to be treated as a US corporation for purposes of US tax. So very punitive. What they're proposing to do here is eliminate that 60% threshold rule and then replace the 80% with 50%. So it's going to be even harder to meet that test. And then in addition, they have included an inversion definition, which is new as well. So, and this would apply regardless of the level of shareholder continuity. And that is, the fair market value of the US company is greater than the foreign acquirer. It's primarily managed and controlled in the US, and no substantial business activities in the foreign acquisition company's country of incorporation. So if we have those three items, then it's going to be treated as a US corporation regardless of the continuity of ownership. These provisions would include direct and indirect acquisition of assets of a trade or business of a domestic corp, a domestic partnership, and a US trade or business of a foreign partnership. And it would also include the distribution of stock. So a lot of nuances and changes there. So if companies are looking to do inversion transactions, it's going to be a lot more punitive or harder to get around those rules. We can go to the next slide. The Green Book also includes some provisions to target increasing US investment. And they're doing both the carrot and the stick here. So they would be providing a credit for onshoring jobs, and this would be a 10% general business credit, 10% of the expenses. And it would be in connection with the elimination of an existing foreign business to the extent it increases US jobs. It would also be available to US territories. So let's say foreign sub in another jurisdiction, you're closing down that shop and bringing those jobs back to the US, that would be applicable. And then they're also, on the flip side, looking at a penalty for offshoring jobs. So disallowing deductions related to moving or starting the same business offshore. So those rules are going to be quite interesting, given that sometimes you need to have local presence in other markets in order to be successful there. And whether that would count, it would happen to the extent that it would apply to the extent that it decreases US jobs. And then it would also disallow deductions for purposes of our GILTI and Subpart F calculations of a foreign company of the US parent company. So the Green Book did note that neither of those provisions would apply to capital expenditures or severance pay. One last slide on some of the large corporate changes. So we envision that, well, these provisions will really apply to the large corporate companies. So if you have 500 million or more in revenue, they will be replacing BEAT with SHIELD. And I'll just give a very high level overview of what they're talking about there. And what they're really trying to do is target low tax income in the group. So think large corporate conglomerate group. And there's some entities that are in very low tax jurisdictions. If payments are being made to those, SHIELD would essentially disallow those deductions. So that's the way that they're getting at, really making sure that you're not getting deductions at higher income tax rates for the benefit of that lower income tax rate. And then for entities or companies with more than 5 million of net US interest expense, it would disallow the interest expense using a ratio of the US net interest expense to financial reporting group's net interest expense. So here, if we're looking at financial statements in the interest ratio is, let's say, 10%, and in the US group we have a 20% interest ratio, it would then disallow that additional interest expense and carry it forward to be used in later years. So something that could apply also to smaller companies, but the 5 million threshold is quite high. Then we have also for entities with 2 billion of pre-tax net income, what they're doing is proposing a 15% minimum tax on book earnings. So a lot of these changes are coming with the backdrop of the negotiations that are happening at the OECD for Pillar 2 and coming up with a global minimum tax. And so this is almost like, okay, we're going to put 15% out, and we're not sure exactly what the OECD is going to come up with, but that could be it. So that's having part of that backdrop there. So I think one of the things to keep in mind is that there are a lot of taxpayers in the US that are foreign owned. So you have a corporate, coming into the US, setting up US operations, et cetera. In terms of whether these items apply, it's going to be really important to have a good diligence of the foreign companies in the group as well, because we wouldn't know on the pre-tax net income, for instance, or I'm sorry, in the 500 million or more in revenue, if that would apply unless we know the grand scope of the structure. So at this point, we will wrap up and give just an overview of where we think these things are going to go as well.
Thanks, Shannon. So you can go to the next slide, Amy. What I'm sure you all have read this because it's been in every paper in the world. The President Biden released two plans: the American Jobs Plan, which is basically corporate income taxes dealing with infrastructure, and the American Families Plan, which is income taxes on individuals dealing with family issues, daycare, that kind of thing. The negotiations for the American Jobs Plan has happened, has started, and it continues to go for some time. The original thought was that it wasn't going to be done until it would be done by Memorial Day. Obviously, that's not going to happen. Jen Psaki, who is the White House press secretary today, said it's open-ended. They're going to wait to see what actually happens. That is a really big sign of how things are going with negotiations. And so far, neither of these plans, the job plan or the family plan, have been turned into legislation. And just for comparison, when the American Rescue Plan came out on January 14th, it was signed into law on March 11th. Basically, the jobs plan came out in March 31st. We are basically dealing with the same timeline that we had for the rescue plan with the jobs plan. And right now, there's not even a bill for the jobs plan. And yet the rescue plan was not only a bill, it was signed into law in about the same time frame. So lawmakers are really taking a lot of time with this. And it's really questionable of how much of this plan is going to be completed. Amy, can you go to the next slide? So here's an outline. I'm not going to read through it, but here's an outline of what's been going on with the negotiations between the Republicans, mostly Senate Republicans, and President Biden. And as you can see, there's been 4 major developments, and it just amounts to basically counteroffers. They're not having any agreement on what they're saying. Biden is not saying, okay, I lower my rate down from 2.25 trillion to 1.7 trillion. And the Republicans are saying, yeah, that's a good idea. I really like that. They're not doing that. And so when you're seeing these counter offers, they're counter offers in the absence of nothing, because no one said, if you make this offer, I will say yes to it. That's not happening here. And so what's going on is that people are making counter offers just to keep the conversation going. And it's not going well, to be honest. Amy, could you go to the next slide? So here was the big ask that Biden did, I think it was last week. He took off temporarily, raising the corporate income tax rate from 21% to 28%. This stunned a lot of people for a few reasons, but one was that the corporate income tax rate was the easier part compared to raising the individual income tax rate, even the top one. The reason for that was because there was a fear from some Democrats that if we raise the individual income tax rate, pastors are going to be affected by that, and that's going to hurt business, and so it'll be harder to do. Let's just do the corporate income tax rate, because that would be an easier sell. Well, Biden took it off the table temporarily and replaced it with a 15 minimum tax on book earnings, which basically is if you pay no tax on your federal tax return, you go to your financial statements and what's your profit there? Well, we're going to tax it 15%. That's by and large what it is. Interesting enough, that actually changes the whole dynamic for curbing taxes from the IRS to FASB. And so it would be interesting to see if this thing is even put into law, how that's going to impact rulemaking here in Washington and Connecticut, where FASB is located. But the whole issue that he took it off the table has really jarred some people thinking, wow. And so what happened when he took it off the table and added those other 2 issues, the GOP said, no, we don't like tax increases. And the funny thing is that he basically is trying to clamp down on people that might not be truthful with paying taxes. That measure was in the American Families Plan. So now that measure goes from the American Families Plan to the American Jobs Plan, and it's a $700 billion revenue. So now the American Families Plan no longer has $700 billion, and the American Jobs Plan now has that $700 billion, and the GOP has still said no. So they're at square one again. Amy, can you go to the next slide? So here's what's going on with these, and it's literally been the same problem since this started on May 12th. They can't define infrastructure. Republicans say it is roads and bridges. Democrats say it is roads and bridges, childcare, family care, a lot of other things, and they're saying no way. How to pay for the bill? Been the same problem forever. Republicans say no tax increases. Democrats say, I'm sorry, Democrats want to increase taxes, which Republicans don't want to do. Republicans want to use fees, but not the gas tax. These fees would be for like miles traveled, and they could probably hit someone making less than $400,000 a year. So Biden doesn't want to do that. Oddly, there's an infrastructure bill in Congress right now that has a miles traveled tax in it that's going to mark up later this week. So who knows if Democrats are going to suddenly say okay with the miles traveled tax, since a committee is now marking one up with one in it. It's kind of interesting. But they also don't know how long the project should last, because a shorter project is less expensive, and so we don't need so many tax increases. And the other side is like, no, let's make it longer, because infrastructure isn't a year bill. Infrastructure projects last through several budget cycles, which can be 10 years a budget cycle. So infrastructure project can go 20 years. And so there is an argument of how long these things should actually last. So in other words, like I say in the bottom bullet point, they are nowhere near a deal, and they literally are arguing about the same thing that they argued on day one. Amy, can you go to the next slide? Okay, so here's some game end hurdles, which I find kind of interesting. Nancy Pelosi, the House Speaker, wanted to pass the bill by July 4th. It's June 7th. So are they going to basically just ram this through every committee? I mean, they haven't even announced markups on this bill. And the infrastructure package going through the infrastructure committee, Jen Psaki said, is not the American Jobs Plan. She said that today. So there is no legislation yet that Congress has done. So in less than 3 weeks, you're going to not only vet it through committee, you're going to pass it. That seems highly unlikely. And the other thing is, let's just say, for argument's sake, that Pelosi could get this through. Chuck Schumer said he would like to work on it in July. The summer agenda for the Senate floor is incredibly packed. They are doing a lot of issues that are non-tax related at all, and will take time to actually work through. And the thing with the Senate is everybody has to agree to do everything. So when a bill goes onto the floor, it's because everyone agreed to do it, or at least 60 agreed to do it. To take that bill off the floor, you have to get 60 people to agree to do it. And if they don't get that 60, the bill just stays there, and they continue to try to work on it. So where this all comes out with the jobs bill is people are starting to think that the jobs bill and the family bill are going to be connected at some point and be one bill. That's a $4 trillion bill for 10 to 15 years. That's a lot of money. And so, but that's just that's the current thinking, and I'll get to why on the next slide. Amy, could you move over? Thank you so much. There it is, reconciliation. So reconciliation is a big word, and it means a lot of things, but the most important thing it means is it only takes 51 votes to get something through the Senate that would normally take 60. Currently, Democrats have 50 Democratic senators, and so they basically would all have to support a bill, and then Vice President Harris would come in and say, I join too, I'll break the tie, and then the bill would pass. The question has become, can they do this? Now, they did reconciliation. They passed it by 51 votes for the American Rescue Plan back in March. So they figure, okay, we will do it again. Well, a big hangup happened last week. The Senate parliamentarian said, if you want to use reconciliation, the bill that you use to pass the American Rescue Plan, if you want to reuse that bill, you have to start the whole budget process all over again. You have to literally write a new budget. You have to put it through committees. You have to have the reconciliation instructions approved by the other committees. Those committees then have to write the reconciliations instructions. You then have to put them together. You then have to put it on the floor and then have what's called a votorama, which can take days, if not weeks, and basically sometime pass it. Because of that, it looks like reconciliation or passage of the American Jobs Bill or the American Families Bill will not happen this congressional year, which ends on September 30th, because Democrats don't think Senate Democrats don't think they can actually move something through all of those processes by the end of this fiscal year. So they're now turning their attention toward federal budget 2022 and maybe working on reconciliation next year, which means that the earliest they could move something would be October of 2021, because that is the first month of fiscal year 2022 in Congress. It seems doubtful that they're going to move something that soon. Oh, that's it. All right, great.
We are right. Oh, get my video. We're right at the hour mark, so I think we'll be respectful of people's time. There's been some questions that have come in, and I think we've been able to answer them. So I think with that, we just thank everyone for attending and stay tuned as things progress. I mean, to Jay's point, let's see what happens. But as things progress, look for further webinars and further insights and articles from us on kind of this evolving tax legislation. So again, with that, I think we'll let everyone go. And again, thank you for attending.